Podcast Network Asia.
You are listening to First Metro Securities Philippine Stock Market Weekly podcast, where we feature timely and relevant discussions on the Philippine stock market and the economy in the hope of providing you investing and trading guidance. Here's your host.
Hi investors, I'm Anjz, Equity Research Associate from First Metro Securities. Welcome to today's special episode where we'll break down our market outlook and strategy for 2026. I'll talk about where we see the index heading, the risks to watch out for, and the stocks we like for this year. We liken this year's strategy with Robert Frost's poem, The Road Not Taken. Basically, it's about two paths and choosing one path without regrets. So I read to you an excerpt here. Two roads diverged in a wood, and I took the one less traveled by. That has made all the difference. So we do recognize that the local market for the next 12 months will course through that quote-unquote model through scenario. That's your familiar or cautious path. But the interesting part here is that even though this one looks most likely, there's the other side or the other road, the road less traveled, wherein this is where confidence returns and the market surprises to the upside. So here is our year-end index target range. Our base case is at 6,500, and that's mainly driven by your EPS growth at 5% for the next 2 years, and also hinged on modest economic growth. For our bear case, that's at 5,500. This is where economic fundamentals deteriorate, with growth slipping below 5%, see around the 3% level. And that's a concern that will result to single-digit corporate earnings growth. Meanwhile, you have our bull case target at 7,500. This is where macro stability risks fade, GDP moves closer to around 6%, and eventually this will translate to corporate earnings growth. This is as progress in governance reforms lift confidence and spending. So we'll go through our key calls this 2026, and this will be the structure of our discussion this afternoon. How we view the economy is that our economy right now, the weakness that you're seeing is more of transitory and cyclical rather than structural, meaning it's not going to last for long. Then on earnings, this is expected to grow below trend in line with the soft macro environment. Current valuations are already inexpensive, which should help cap any potential downside. And on foreign funds, outflows have already bottomed out and we're already seeing early signs of reversal. So last year, when we marketed our 2025 strategy, we did mention that we're seeing the business cycle transitioning from that slowdown phase to an early recovery phase. And for a while, that seemed quite true. If you look at first quarter 2025 and second quarter 2025 GDP figures, both of them are at the 5% level. However, come the third quarter, GDP was at 4%, momentum stalled. And this is actually the lowest pace or the weakest pace in over a decade, excluding your pandemic years. So what caused this dip? It's actually a mix of calamity, disruptions, delayed government spending due to corruption probes. There's also shaken confidence among your consumers or among households, like what Dr. mentioned a while ago. BSP has this consumer expectation survey wherein in the third quarter of 2025, CES was around -9. And then for the fourth quarter, it turned more negative, down to -22.2. So this was affected by the graft and corruption probes, inflation concerns, lower household income, and the calamities, the typhoons, the earthquakes that hit the Philippines in the latter part of last year. And then you're also seeing deceleration in retail sales recovery. For some bigger ticket items, say car sales, for example, we're seeing decline in sales here as well as of November 2025 data. So even with inflation under control and interest rates easing, people still held back on spending. And then for other economic data points, it's a mixed bag. You have here manufacturing PMI. Ideally, you want this to be at the 50 level or even better if it's greater than 50 because that will signify that manufacturing activity is growing. So in November of 2025, PMI was around 47.4, and then it rebounded to 50.2 in December 2025. So that's a win for us. Now, if you look at job losses in the services sector, this is where we're a bit concerned, particularly in the services sector, BPOs, for instance. So as more companies adopt AI, yes, there are productivity gains there, but the trade-off is clear. Fewer people are going to be needed to perform the same work, and that could lead to job displacement and eventually weaken consumer sentiment. Now, if you look at liquidity, there has been excess liquidity which had stayed high for quite some time, but it's already beginning to taper off. In terms of money supply, it's still growing below historical levels, but we take comfort that it is already improving. Now, looking at corporate earnings, a soft economy will reflect in soft corporate earnings as well. We're looking at 5% per annum in the next 2 years, and this is aligned with our partners at BBS forecast 5% levels as well. Looking at it for the next 12 months, similar to the economy, we expect corporate earnings to move in a quote-unquote model through scenario because demand is still being held back by weak confidence and a softer economic backdrop. At the same time, their costs are creeping up, which means companies may not get the same boost from operating leverage that they have enjoyed in recent years. And then there's spending constraints coming from your weak consumer sentiment, rebuilding efforts post-calamities. So for context, the higher income households, they account for the bulk of total annual consumption. So for those families who were affected by the calamities last year, their spending will shift toward consumer staples more than discretionary spending. So reduce expenditure on, say, restaurants, accommodation, travel. These industries will be directly impacted because their manpowers rely on your lower income households. So as a result, the slowdown in consumption among wealthier households cascades through the economy, dampening overall activity. Then there's also sensitivity surrounding excessive display of wealth. We spoke with SSI management late last year, and we've been hearing from them that they saw weaker demand for luxury items. So even if, for example, these consumers are not affiliated with politicians or the like, they don't want to be involved in that type of scandal. They don't want to be questioned where they got their money from. So they're kind of like shying away from buying designer items. So that's less discretionary spending. And speaking of discretionary spending, you have your concerns on job security. Your BPO workforce, which are earning above minimum wage, they are the ones who have more propensity to spend. So if, for example, they face job displacements because of AI, they might tighten their belts in spending. And again, that would lead to less discretionary spending. There's also cost pressures coming from the following. First, companies are facing higher wages. This will likely to remain in the mid to high single digits, reflecting tight labor market dynamics and rising minimum wage standards. Companies also would be investing in digital transformation and AI. Yes, in the near term, this would be additional on their expenses, but in the longer term, in the future, this will contribute to their productivity gains. Currency weakness and sticky borrowing costs as well are adding pressure. We are net importers, meaning we import more than we export. So a weaker Philippine peso versus the greenback is more costly for us. So in short, earnings should hold steady, but upside will depend on confidence and the recovery in spending. For now, companies are navigating a cautious environment where costs are sticky and revenues are capped. So we're coming from a soft echo and earnings expectations like what I previously discussed. Now, we're shifting gears to a more bullish stance. Let's talk about valuations. You can see here there is a path to the road less traveled that's closer to the 7,500 index target range for us. Looking at it on the valuations, We acknowledge that near to medium term challenges are present and risks are skewed to the downside. However, a slide to our bear case of 5,500 would require a deeper erosion of confidence and even weaker than expected economic data points or even earnings growth. In short, when a black swan event happens. So, a black swan event will catalyze higher ERP, probably like the one seen or historically during the crisis periods such as pandemic, global financial crisis, and etc., which also had high equity risk premium. But the way we see it, it's very much unlikely for a black swan event to happen in the next 12 months. Having said that, we are of the view that current valuations are low to begin with and should limit the extent of any underperformance. So again, our economy that we're seeing right now, which is kind of weak, it's transitory and cyclical. They're not here for long. For now, we think that there is still a case for a return to stronger growth, and this will hinge on these three factors. First, you want for the businesses and consumers to feel secure again. That means decisive government action on corruption, transparency in public projects, and faster recovery after the calamities. Also, you want to see public spending to normalize. So, infrastructure disbursements have dropped sharply, but with better governance and fiscal discipline, we are expecting a catch up in spending and more efficient project execution. Support from the BSP as well will play a big role by carefully easing rates or lowering reserve requirements to boost liquidity. So, while 2026 may start on a soft patch, we believe that the weakness is temporary. With confidence restored, government spending back on track, and monetary policy lending support, there's a clear path to stronger growth ahead. So still on valuations could expand, ERP will go down with a modest shift in sentiment, and this could unlock confidence and catalyze positive momentum and lead to a meaningful contraction of equity risk premium. Thus, despite our cautious stance, we see a path toward a more constructive outcome for the market this year. We see three scenarios that could steer the market toward our bull case target. So again, how do we get to that 7,500? We want to see these scenarios to play out. So first, if you talk about governance reforms, we're talking about government action that should go beyond putting some people in jail, but actually having transparency and putting safeguards in place. Second, you want to see the economy firing on all cylinders, so that's strong GDP growth, stable macro conditions, and supportive monetary policy, which could shift the narrative from weakness to strength. Third, you want to see foreign investor inflows. A big return of foreign funds would lift valuations and help close the gap with other emerging markets. Of these, we think that the first and third scenario, the government reforms and foreign fund flows, we see that they are more realistic drivers. In fact, foreign flows are already showing signs of recovery, with outflows slowing and recent data turning positive. I think it was last week we had net foreign buying around 2.1 billion, so that's a good sign. Also, this week, recently, we reached around the 6.4 level, and we are close to our base case of 6.5 because of scenario number 3, a market inundated by foreign fund flows. Hence, we are now pricing in the 7,500 bull case. Now, talking about foreign funds next, we see this as a wild card for 2026. After years of steady outflows, the tide has started to turn. In fact, if you look at September 2025 rolling 52-week flows, these have turned positive already, meaning foreign investors are slowly increasing their exposure to Philippine equities. And then moving into this year, we expect inflows to continue, and it will be driven more by your passive foreign funds. And they're going to ride on the broader optimism around emerging markets. So when money flows into the EM funds, even smaller weight countries like us, the Philippines, would benefit. Without the drag of active selling, these inflows could have a bigger impact, supporting valuations and helping close that gap or that performance gap with our regional peers. So we view that or there's a global view that emerging markets will outperform this year. Again, that's going to be more passive than active flows. But the question here now is, how do we know that or if these fund flows are sustainable? So actually, if you look at it, Philippines is underweight. Foreign exposure is very low. So there's a strong likelihood that they or your foreign funds can increase more exposure to the Philippines. Of course, there are risks to our view. This could prolong the current soft patch and stall momentum. You have, if for example, more weaker than expected economic data points come out this year, and then you have unexpected scenarios like climate risk, external factors such as weakening Philippine peso, and BPO sector facing structural headwinds. Now, knowing all of that, how do we leverage? What we're proposing here is a barbell strategy still. On one end, you have your dividends and defensives. On the other hand, you have the large cap and cyclicals. And there's an emerging theme here in the middle, the AI diffusion winners, which I'll get to later on. Note that we cannot recommend the following stocks: Metrobank, GTCap, Yes Bank, because we are all part of that group. So yeah, let's go through the themes one by one. First, you have the dividends and defensives. These would be your familiar path. These are the stocks that give you stability when the market feels uncertain. We're talking about companies with strong cash flows, resilient business models, and steady demand drivers. On top of that, the government is boosting its budget for social services, ayuda, so around 34% of this year's spending. That means more cash transfers to households, and when these households have more funds, these will go through the following sectors. They're going to pay for utilities, telcos, for the loads, for example, consumer staples for grocery. And in this space, our top picks would be the likes of Arit, Globe, Tel, Mer, Pure Gold, URC, and RCR. Next one would be your large cap and cyclicals. This is the road less traveled path. This is where conviction comes in. If confidence improves, whether through stronger economic recovery or progress in governance, these names could see meaningful upside. So the likes of BDO, BPI, Ali, SMPH, JFC, and SM. Now, the third theme that we have here, this would be your unmarked trail. Your AI diffusion beneficiaries is an emerging theme. While still early in the Philippines, AI adoption is becoming a structural driver of productivity and competitiveness. Companies that integrate AI into their operations or say customer engagement or supply chain could see long-term earnings uplift. Here we like banks, telcos, utilities, particularly the following names: BDO, Converge, Globe, Mer, and Tel. Now, quickly showing here the summary of our top picks. And if you look at this column, dividend yield for 2026, where dividend picks here have a higher yield than the Philippine one-year bond yield of around 4.9%. So, AREIT, you're going to have 5.4%, so that's definitely higher. Globe feels like a no-brainer at 6%. PLDT as well, RCR, and URC. If you found this helpful, make sure to follow us on our socials for more updates. That's First Metro Securities on Facebook, Instagram, and YouTube, and FirstMetroSec on TikTok. Got a topic you'd like us to cover? Drop us a message. We'd love to hear from you. Thanks for tuning in. And from all of us here at First Metro Securities, happy trading!
Thanks for listening to First Metro Securities Philippine Stock Market Weekly podcast. Don't forget to follow us to get first dibs on our new episodes. For more up-to-date market news and info, exclusive content, and the opportunity to connect with your fellow Filipino investors and traders, join facebook.com/groups/FirstMetroSec and be part of the First MetroSec family.
First MetroSec is providing this podcast as a general market commentary. Reference to any specific security, product, or entity do not constitute as an offer or a solicitation of an offer to buy or sell any financial instruments or to participate in any particular trading strategy. The statements, comments, views, or opinions expressed by the hosts are subject to change without notice, and FirstMetroSec is under no obligation to update, amend, change, or correct any of the statements, comments, views, or opinions expressed. The statements, comments, views, and opinions expressed by the guests are their own and do not necessarily reflect the view of FirstMetroSec. FirstMetroSec disclaims any liability arising from reliance on or reference to any information obtained in this podcast.
The views and opinions expressed by the podcast creators, hosts, and guests do not necessarily reflect the official policy and position of Podcast Network Asia, the hosts of the program, or other programs of the network. Any content provided by the people on the podcast are of their own opinion and are not intended to malign any religion, ethnic group, club, organization, company, individual, or anyone or anything.